With a negative free cash flow of $23.69 billion, you might assume Oracle faces a severe liquidity trap. Yet the market celebrates this capital burn as a strategic victory. First, let's examine the remaining performance obligations of $638 billion, representing total revenue from contracts signed but not yet delivered. A remaining performance obligations surge of 363% implies guaranteed future market dominance. Wall Street currently views this enormous backlog as guaranteed cash, especially knowing Oracle secured customer hardware prepayments of $75 billion. However, you must realize that these prepayments are massive logistical liabilities that Oracle must physically deliver as operational data centers. If supply disruptions delay delivery, this towering backlog of $638 billion morphs from a financial blessing into an operational bottleneck. A golden rule in value investing is that a backlog is only as valuable as the execution ability of a company. To truly understand why execution is becoming so incredibly expensive, we examine the capital expenditures of $55.66 billion deployed this fiscal year. Capital expenditures represent funds used to acquire physical assets like technology infrastructure, acting as the foundation for future growth. You must ask why a software company is suddenly spending $55.66 billion like an industrial manufacturer. The mainstream financial media praises this massive shift, noting the capital expenditures increase of 162% as a bold competitive move against rivals. Subtracting this massive investment from operational cash generation leaves you with that negative free cash flow of $23.69 billion. This negative figure highlights the exorbitant financial cost of competing in the modern technology landscape. To fully grasp how this shift impacts the bottom line, examine the implied gross margins of 65.2% for the past fiscal year. Implied gross margin represents the revenue remaining after deducting direct service costs, revealing true core profitability. How does a company with record-breaking sales experience such declining profitability? Revenue beats often distract the public from the fact that implied gross margins contracted from the prior year's 70.2%. This 5% compression illustrates a fundamental shift in the business model toward highly capital-intensive cloud infrastructure. Building and powering physical data centers simply costs significantly more than licensing digital software. During fundamental analysis, you must monitor this trend closely because revenue growth must outpace shrinking margins of 65.2% to justify the valuation premium. Relying on one single metric is incredibly dangerous, as revenue growth looks phenomenal, but margin health dictates long-term survival. And this is something you can easily check for yourself in any quarterly report. As those margins compress, the need for outside capital grows, bringing us to the total debt of $129.54 billion sitting on Oracle balance sheet. How safely can a tech firm navigate market volatility while carrying such an enormous burden? Many assume tech companies borrow indefinitely, especially as Oracle outlines a planned capital raise of $40 billion next year. To see if this massive debt successfully captures market share, look directly at the fourth quarter cloud infrastructure revenue of $5.8 billion. A cloud infrastructure revenue surge of 93% proves the company is indeed capturing vital territory in a fiercely competitive sector. Yet this explosive new growth is accompanied by persistent friction in their legacy segments. Oracle is essentially cannibalizing its older business, evidenced by the traditional software revenues decline of 2%, to feed its new infrastructure machine. The core narrative tension centers on whether the new infrastructure segment can scale fast enough to permanently replace those highly profitable legacy models. Applying solid stock market analysis, you must recognize that business transitions of this scale are rarely seamless. We must carefully evaluate the forward revenue guidance of $90 billion projected for the current fiscal year. Mainstream analysts are aggressively pricing in a forecasted cloud growth projection of 58 to 64%, meaning Oracle has essentially priced in perfect execution. Setting a forward revenue guidance of $90 billion means executives have cornered themselves into delivering flawless quarterly beats, leaving the stock highly vulnerable to operational missteps. To maintain this immense growth trajectory, Oracle completely altered how it rewards shareholders, deploying share repurchases of exactly $95 million this fiscal year. A share repurchase occurs when a company buys its own shares, thereby reducing outstanding stock and concentrating ownership. Retail investors are heavily accustomed to artificial earnings per share inflation through consistent buybacks, expecting constant support for the stock price. But management practically halted this practice, underscoring the necessity of redirecting available capital toward their capital expenditures of $55.66 billion. By limiting share repurchases to just $95 million, Oracle signals that physical expansion is now a matter of ultimate corporate survival. Investors who previously relied on those lucrative buybacks must now depend entirely on organic operational growth to drive equity value. We find our definitive answer by looking at the trailing four-quarter operating cash flow of $31.98 billion. Operating cash flow is the total money a company brings in purely from its regular business activities. A casual observer utilizing superficial fundamental analysis might only see massive capital expenditures alongside negative free cash flow and immediately panic. They entirely miss the crucial fact that this operating cash flow surged 54% over the previous year. This robust generation of $31.98 billion is the financial lifeline of Oracle, keeping the entire sprawling operation comfortably afloat. It easily covers the annual dividend payouts of $5.79 billion without forcing the company to dip into debt reserves. Oracle also absorbed a net tax expense of $933 million flawlessly, showcasing profound operational resilience amid massive spending. Furthermore, the Americas revenue of $44.48 billion continues anchoring the global business, proving their core operations remain robust. Beneath the aggressive capital expenditure spending, the foundational software operations remain highly lucrative and deeply cash generative. So, is the negative free cash flow of $23.69 billion a glaring sign of a failing company, or the acceptable cost of securing future digital dominance? Oracle is successfully capturing essential cloud market share, but doing so requires an unimaginable amount of deployed capital. The immense backlog and strong operating cash flow of $31.98 billion prove underlying customer demand is real. Yet the contracting margins of 65.2% and the massive debt load mean the financial margin for error is razor thin. The fundamental valuation will ultimately be decided by their ability to seamlessly convert those capital expenditures of $55.66 billion into tangible revenue. It remains a compounding machine only if they can physically deliver on prepaid contracts without triggering overwhelming financial strain. But I want to hear your take. Do you think Oracle can successfully manage this enormous debt burden and physical infrastructure build-out, or will these escalating costs eventually catch up to them? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.